Hi everyone, this is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a hedge fund manager at Baring Asset Management along with Bill Wagner. He's been managing a hedge fund for a while. They had a lot of success shorting before the 2008 financial crisis. He's a follower of the Austrian School of Economics and he's worked in the financial industry for over 25 years. Kevin Duffy, thank you for joining me again.
Thanks for having me, Jason.
Now, Kevin, you just put out a really long report summarizing, 2017, your thoughts on 2018. So you were talking about rising rate environment. Do you think the central banks, we've had, some interest rate increases. Do you think the central banks are going to actually be able to reduce their balance sheets?
I think they will. I think they'll at least give it a try. And part of that is that they're playing a confidence game. And I think after 9 years of this experiment, they really are expected to lower rates. So I think that's part of it. But I think also they're dealing with inflation especially in Europe, and I think they've got to. They're really constrained by this. It's really sort of forcing their hand. So yes, I think they're expecting to. Raise rates 3 times next year. The Fed's balance sheet is expected to go from 4.4 trillion to 4 trillion, and in January the ECB starts to trim its balance sheet, not trim its balance sheet, but the purchases they're cutting in half. So I think the market is incredibly complacent ahead of this, not necessarily tightening, but getting towards tightening, let's put it that way.
So in 2017, it seems like, the main creators of money and credit out of the central banks were not really the Federal Reserve. It was mostly the Bank of Japan, the European Central Bank, and then the People's Bank of China. I think the People's Bank of China created more money and credit than all the major other central banks combined. So do you expect to see maybe China get in trouble in the near future? Is the probability high then that the next financial crisis could start in China more than another place?
Yeah, absolutely. I think there have been several drivers of the great bull market of the last 9 years, and at the margin, China was a big player. They really decided to kind of copy the Bernanke playbook and get into the game, and they did in a big way starting in 2009 when the money supply grew 30% year over year and bank lending doubled. They have a severe debt problem, and there was a guest on Grants recently on one of their Grants Interest Rate Observer, their podcast, and an expert on China, and he was saying that right now the debt service costs are growing faster than GDP, and that's the definition of a classic Ponzi scheme. So I think their hands are tied as well. I don't think that the People's Bank of China is going to be able to keep the bubble going. You also mentioned the Bank of Japan. The Bank of Japan, year over year growth in their balance sheet a few years ago was up around 40%. A year ago, it was about 23%, and at last check, it was 10%. So we've already seen a serious deceleration, and I think that's a part of the problem. Is that if you look at the last 2 bubbles, we had the tech bubble where rates went, the yield curve went negative. And the same thing happened in about 2006, 2007, and those marked the tops in those 2 bubbles. This time, long rates are still slightly above short rates, but I don't think it's going to take a negative yield curve this time to pop the bubble. And I think part of that is the idea that there's been no alternative to stocks, and that as long as the S&P 500 yield was above, let's say, the 2-year Treasury yield, people needed an alternative and they put money into the stock market. But now the 2-year Treasury yield's about 1.85%, and the S&P dividend yield is about 1.8%. So this is the first time you're getting basically risk-free money is paying you as opposed to the S&P 500. This is the first time that's happened since September of 2008. So I just think this is a sea change that hardly anybody is paying attention to at this point.
That's very interesting. And so I think the central bankers, I think if I could sum up what they've done in 2017, I think they went wild compared to, even the previous years, especially, in China, the Bank of Japan, and the European Central Bank. The Dow, Kevin, went up 5,000 points in 1 year. It's a record. We're almost at Dow 25,000. So, it's just enormous. The other thing is, European junk bonds trade at a lower yield now than U.S. Treasuries. We have a huge bubble now in emerging market junk bond debt. So it seems like, these central bankers, Kevin, have created basically a bunch of new bubbles after the 2008 financial crisis. And these bubbles seem like they're all $1 trillion in size or larger now.
Yes, and but I think the change, though, is there's a certain amount of inertia that's going on, a certain amount of momentum that is carrying this. And it's almost like nobody wants to leave the party. Nobody wants to leave the casino. It's paid off for so long. And so the early warning signs get ignored in the beginning. And we've seen this before at major turning points. If you look at the early 1980s with financial assets, the bond market actually bottomed and interest rates peaked in September of 1981. But the stock market and the inflation rates had already been coming down quite a bit. So this disinflation, which was the big driver of especially the early stages of the bull markets, the signs were already there. It was already happening. But the stock market didn't bottom until August of 1982. So I think you're seeing a similar thing happen today. The bond markets peaked and interest rates bottomed in July of 2016. And so what we've seen since then is a rising rate environment, pretty much across the board. And as you mentioned, Jason, high yield bonds and that kind of thing have not rates have not gone up there as much because those have been more of the frothier markets. But so I don't think this is all that unusual that we would ignore the warning signs. But you can only do that for so long.
Do you think the tax cut bill that Trump and the Republicans in both houses of Congress, do you think that's priced into the stock markets now?
Yeah, I think that's a great point. That's probably a big reason. That's been a distraction and maybe a good excuse for investors not to really be paying attention to this rising rate environment. They've been really just totally focused on the tax bill, and which I think is really very overrated. First of all, David Stockman did an analysis on this yesterday, I believe, and he was comparing it to the tax cuts today to the Reagan years, the Reagan tax cuts. And I took some of his numbers and looked at them in terms of GDP. The average during the Reagan years, the average year was about a 4% of GDP tax cut. And this time, the average is going to be about 1%. And of course, it's kind of front-end loaded. So in 2019, that's the peak cut. You're only talking about 2% of GDP. The other point that a friend of mine, Michael Polaro, made is that there's a big difference because they're really not cutting marginal tax rates, personal marginal tax rates like they did in the Reagan years. There's, I think this is overrated. But another really important point about this is that tax cuts really aren't tax cuts unless you have spending cuts alongside. And what we're doing right now is we're actually increasing spending. And so you're seeing the deficit widen. I think if we look at last year, the deficit was around 580 billion, and we're approaching 700 billion right now. So, and in the past, there's a very strong correlation between the direction of deficits and the stock market. I mean, if the deficit increases, the stock market tends to follow. So there's been a big disconnect since the Trump election. And I mean, we're guessing that, again, it's like the momentum is carrying this, and you're ignoring the warning signs, but that can only go on for so long, and eventually that disconnect reattaches itself.
I completely agree. As a libertarian, I think private sector tax cuts on small business, corporations, individual income tax is important, but they haven't cut any spending. So the budget deficits, and Trump wants to do an infrastructure program, and these things are all promises for more. He wants to rebuild the military. He wants to increase the technology of the military. These are all expenditures, and so I don't know how he's going to pay for them without borrowing more or having the Federal Reserve creating more dollars, money and credit out of thin air.
Yeah, and it's another result of this, or unintended consequence, is that this is going to put more pressure on rates. I mean, the spending, to just keep on spending, and at some point, the government has borrowed short term. So this is another problem. They've really boxed themselves in, and they're in this this fantasy world right now where they think they can get away with it, and they can't. They can't just keep on doing this and spending money and running up deficits. It's all leading to one thing, which is we have, this everything bubble. A big part of it is this global bond bubble, especially this sovereign, but it's sovereign and corporate, it's high yield, it's across the board. But they're just putting more and more pressure on with the debt and the deficits and the short-term borrowing at the short end of the curve. So it's amazing right now when you look at government bonds. The real yields. I mentioned earlier about inflation. I just looked at the German 10-year. It's yielding 42 basis points. The annual inflation rate is 1.76%. So the negative real yield in Germany is 1.3%, a little over. The negative real yield in the UK is about 2%. The negative real yield, or the real yield in Switzerland is about -1%. So, I think Jason, if you looked at all the government debt out there, and it's gone up dramatically over this cycle, if you look at, I think most of it is at negative real yields. Even Portugal, Grants pointed this out in their latest issue, even Portugal was able to borrow money at I think 1.1%, and their CPI is running 1.4%. And this is one of the countries that was bailed out 6 years ago. So it just can't continue.
Yeah, it's gone on for a while, but it's dystopian. The central bankers have distorted the markets. They've changed the rules. They screwed over Italian bondholders a while ago. I think it was 90-day paper that they switched into 10-year bonds in Italy. So, these are rules changes. This is what happens, in basically immoral banana republic type of governments, but all these governments are acting like this. What's your opinion on the leverage short volatility trade in the VIX and the major stock market indices? I know you talk to a lot of other big name investors, hedge fund managers. You go to Grant's Interest Rate Observer. So what's your opinion on this trade? How overcrowded is this leverage short volatility trade?
Yeah, and this is it's remarkable. We haven't had a 3% correction in 12 months. Today, you look at Bitcoin. Today, Bitcoin traded in a range of 22%, and the Nasdaq 100 traded in a range of 0.5%. So we have, in a sense, we have borrowed from the future. So we've drawn forward consumption from the future, but we've also we've sort of put off volatility. We've suppressed it in the present, and we put it off until into the future. So, yeah, I think you mentioned it was probably the Commitment of Traders report that shows there's a heavy short position in volatility futures, and this has been the trade that has just worked incredibly. But the VIX futures, so if you look at the 3-month VIX futures, they're trading at about 13.5 right now, and the lowest that they traded during the credit bubble was right about this level. So I think these traders are. It's a very crowded trade, and it's like picking up dimes and nickels in front of steamrollers right now.
Yeah, I believe the trade, according to hedge fund manager Christopher Cole of Artemis Capital, is over 1.5 trillion in size with leverage. I've heard anecdotal stories of portfolio managers for like European pension funds, managing retirement money, and they wouldn't put any of their own money into this trade, and yet, they're using leverage for people's retirement accounts to pull this trade off. It's pretty insane.
It is.
Now, I want to ask you about shorting, since you've had a long career track record of successful shorts. Do you speak with Jim Chanos about his short picks, and what about his new picks about Netflix and the burger restaurant chains?
Yeah, I don't know Jim, but I'm a big admirer of him, and certainly whenever he's on TV or there's a podcast, I try to pay attention to what he's doing. Yeah, and I'm not familiar with his thesis on Netflix or the burger chains, quite frankly. But I'm guessing that with Netflix, I mean, we're not short Netflix, but I think what's going on right now is that he's probably picking up on some of these firms that have negative free cash flow and are really spending a lot of money. Netflix would be one of them that's running negative free cash flow.
Yeah, they've borrowed what, $20 billion to produce all of this content that we like. So long term, That's not really a sustainable business model. I mean, they raised their prices a little bit, but I don't know how much of the debt they're going to be able to pay off with raising the prices $1 a month. Yeah,
and this is the thing, is that companies right now, when you lower interest rates, it really it creates this long-term focus, and companies can. It opens up the imagination. You can just totally dream, and really, you're not held accountable in the short run or in the immediate, the medium term. I mean, it's really this long-term focus that's going on, and the market, as long as the stock goes up, they can spend this kind of money. I heard something about the amount of spending that they're doing it's huge in terms of Hollywood right now. I mean, you really have to be paying attention to what Netflix is doing.
Yeah, they're spending a lot of money now promoting on TV commercials this new movie with Will Smith that they supposedly spent over $90 million on. It's their first, quote unquote blockbuster. But in your opinion, Kevin, is it easier for you now to run your stock screeners and find stocks to short than it is to find good companies to go long on?
Yeah, we do a lot of bottoms up work, and we're finding a fair number of ideas on the long side, and I think that's a function of this rotation that's going on, and the fact that you've had this funneling into the FANGs, and you've had the indexing, the passive bubble that's going on. So it's the index divide. If you're on the right side of the index divide, then flows go your way, and if you're not, then these stocks kind of get abandoned. So there are some ideas definitely on the long side that we're seeing from a bottom up, but definitely much more on the short side.
Do you think then it's highly probable then, given some of the risks that we've already highlighted in this interview, that we're going to have another stock market crash in the next couple of years?
Oh, I think we will. I absolutely think we will. There's too much leverage. I mean, when you look at the margin debt figures and the levels that we've had before, they're very, very similar levels in terms of GDP. Of course, they're because the GDP is higher. The margin debt levels are at records, and then you have securities-based lending, which is not showing up in the margin figures, and that can add. So I think we're at, what I say, 580 billion in margin debt, something like that, and so there have been estimates of 100, 200 billion in securities-based lending on top of that. So it's not really, there's so much leverage, it's not designed to go in reverse. So yes, we haven't had a correction of 3% in 12 months, but what happens when we go down? I don't think it's going to take much, Jason, maybe maybe a 5% correction where all of a sudden buying the dip doesn't work, and then it starts to cascade.
As a hedge fund manager, your risk management tools are probably a lot different than our retail listeners. Do you employ married puts? Do you employ trailing stops? Do you keep extra cash in your account if you think the likelihood is increasing of a market crash, or do you start to liquidate a lot of your long positions, like what happened during the 2008 financial crisis? Is that what you're planning on doing soon?
Well, we haven't. I think we've done a very good job of managing our risk. It's been very difficult because when you have 70 new highs in the Dow, it's a constant headwind. But what we try to do on the individual shorts is use mostly puts. We don't do that many individual short positions, and that really helps because, so for example, if a stock is in a very strong uptrend, we'll do out of the money puts. We'll just throw something out there, but if it starts to roll over and technically start to go into a downtrend, then the puts will be in the money and we'll have more at risk. So it's a way of us managing our risk. And the beauty of having a put is that if a stock gets taken over or it goes parabolic, it doesn't destroy you. That's a built-in stop loss.
Yeah, I agree. I think puts are a pretty safe way to short a stock or an ETF compared to outright shorting the individual stock. I remember the other thing is the percentage you pay to borrow on a short. So you could be paying a lot higher than 10% to borrow the stock. You have to pay back dividends. So it gets, if every hedge fund, a large percentage, are short the stock, it can get very expensive then to short the stock. It becomes a very overcrowded trade and too expensive, and it's not worth the profit potential and the risk.
Absolutely. You have to pay it. There are many sides of the short selling aspect, and you have to pay attention to your borrow costs. You also, and they show up in terms of implied volatilities on the put options. So every one of these bubbles is different. If you go back to the tech bubble, the implied volatilities, the stocks that you wanted to short, let's say Juniper Networks. I don't remember what the implied volatility was, but let's say it was 50%. I'm probably not too far off. It might have been higher than that. You look at something like Tesla today, the implied volatility is maybe 35%. And then you look at bank stocks back in the credit bubble, and the implied volatilities were maybe 15%. Today, on the S&P 500, something like 12%. So you have to look at what you're paying in terms of your option premiums. And the beauty, I think another reason why we're so excited is that the implied volatilities are so low because obviously volatility has been suppressed for so long. And so that's a big arrow in the quiver, so to speak.
Are there any particular industries that you think are very good longs, kind of no-brainers, that they've improved their balance sheets, their cash flow is strong, their valuations are very reasonable, like maybe gold and silver mining or something along those lines?
We have a few areas that we look at. So gold and silver mining, that is almost a separate category. We don't see them necessarily as longs, although they are longs, but it's a different way of playing the precious metals area. The problem with those stocks is that they're just tough businesses. So we like to see really trends, long-term trends at our back. We like to see the valuations, but we like to see good businesses, and that's the only caveat. But that said, I think the conditions are right. You have lower costs. You have, I was told by a mining expert that 9 out of 10 projects that are taken on in the mining space come in over budget, and the 1 in 10 is always when times are tough. And so that's where we're at right now. Capital is very hard to come by. that's a good thing. It forces a discipline. So all these things are positive. But there are some other areas. We aside from that, which is really sort of magnifying the insurance policy aspect of the portfolio and protecting against the downside, we're always looking for basically to get long human ingenuity, human progress. And so it's looking at some of these longer term trends. There's, the aging population, the over 65 demographic is going to grow by something like 50%. It's over the next, I don't know, 20 years or so, and it's the fastest growing demographic in the world. So looking at long-term secular trends and also data, being able to, a lot of these successful models have been sort of data driven. And so, something like genomic sequencing and the cost, and we're also looking at deflations. When you see the cost of sequencing the genome that used to be $1 billion in 2000, now it's under 1,000, and you have companies like Illumina that are driving that down. And this is not an endorsement of Illumina right now. The stock's a little pricey and we don't own it, but there's a company like Regeneron that sequenced 250,000 people, and the stock trades at about 21 times R&D. If you look at the last 5 years, it's traded in the range of about 20 times to 40 times. So there are some opportunities like that. I'm also, another area, we like to look for simple narratives and start to question those simple narratives. And I think one that's happened has been this idea of Amazon being Amazoned, and that retail would all retail would get wiped out by Amazon. And I think the reality is going to be a little more nuanced than that. Doesn't mean it's not going to be it's going to be easy sledding here, but there are a lot of stocks that have just gotten tossed into the trash heap. And so I think there's some opportunity to do some kind of rummaging around in that area. And then even energy has kind of underperformed this year, and we're starting to poke around with looking at the offshore drillers, and even the natural gas E&P companies. So potash is another area.
Yeah, uranium is also an interesting story too, because for the bear market has lasted so long, it got extended with Fukushima, and I think at some point up until the production cuts recently from all the larger uranium producers, I think some of the uranium producers were losing $40 or $50 a pound, which is obviously not sustainable either.
Yeah, we don't have a position in uranium, but we have in the past, and it's certainly on the radar. But I think kind of poking around some of these areas in the commodity space, probably not a bad idea.
Last question then before I let you go. China has almost a $40 trillion credit bubble. Where do you think the next crisis will start? If you had to put probabilities on things like either European banks, European junk debt, China, emerging markets, where do you think are some of the more likely hotspots where the crisis will start?
Wow, that is almost an impossible question to answer, because there are so many bubbles going on right now. I really feel that China is a huge bubble. The FANGs, you look at some of the excesses, the employment at Amazon.com during this bull market has gone from 25,000 to over 500,000. There has to be waste going on. So, and it's a very crowded trade, the FANGs. But in the past, we've seen the most marginal areas have been the first to go. So in the tech bubble, it was the dot-coms. In the credit bubble, it's the subprime lenders. And I wouldn't be surprised if it might be the cryptocurrencies that actually they're sort of the last area that's it's gotten this huge, crazy speculation, and we're seeing some, really bizarre things happening, like Long Island Iced Tea the other day changed their name to Long Blockchain, and the stock went crazy. And that's the kind of stuff that's really late stage speculative behavior, late stage bubble behavior. So it could come something like that, Jason. It might be. Bitcoin was down 17% today. At one point, it was down, I don't know, 25%, and it's hard to say where it will come from. But my guess is that it would be something really marginal like that, and but it could. But this is the problem: is once it starts, and whether it starts with the cryptocurrencies or whether it starts with the bond market or China or the FANGs, all these are very crowded trades. We talked about the short vol trade. They're all connected.
Yeah, and a lot of hedge funds, I watch Real Vision TV. I don't know if you subscribe to there, but a good amount of hedge fund managers have started to short the shale oil producers because of their balance sheets. To maintain production, I think some of them, their debt has exploded like hundreds of percent in the last 5 or 6 years. So those are, and the oil price, obviously is struggling to stay above a certain level.
Yeah, it could come from just about anywhere.
Well, we've had a very interesting discussion. I don't know how much longer the asset prices can continue at these levels. It kind of reminds me, Kevin, of what von Mises and Rothbard were saying if you go through the Austrian School books about how a lot of the monetary inflation with the increase in money and credit would go into the capital markets first. Because I think, a lot of the current Austrians, they said, there would be hyperinflation, the money would go into consumer prices. But if they went back and actually read the books of von Mises and Rothbard, that's not what they said. They said the money would go in the capital markets first. And, since the 2008 financial crisis, what the central bankers have done, it seems, is what von Mises and Rothbard basically predicted would happen with the majority of the money and credit going into the capital markets first.
Yeah, exactly. That's what's happened. And I think the other thing is, it sort of follows the monetary inflation follows the path of least resistance. And we talked about oversimplified narratives, and I think you're right, Jason, that in the sort of the Austrian camp, libertarian, anarcho camp, the narrative has been, okay, they're going to print money, and this is going to lead to price inflation. Eventually, give up on the currency, hyperinflation, and you buy gold, and it's that simple. And it's not that simple. There are some basic rules, but not too many. And I think one is that whatever the previous bubble was, once that bubble bursts, the new money will not flow into that bubble. I think we can kind of count on that rule. I think another thing that happened during this cycle, which is very different than the tech bubble in 2000, that tech bubble was an initial wave where you have the pioneers take the arrows in the back. And so you had 1,600 online pet supply companies, and which reminds us today of the cryptocurrencies, where now you have, I heard the other day, actually from my dentist today, he said there are 1,300 cryptocurrencies. But this time it's the second wave, the second technology wave, where you have the huge shakeout, and then the pioneers clean up. So I think that's what's happened this time, is we were set up for the second wave of the internet, Tech 2.0, and the money flowed in. That's where, and you're right, it went into the capital markets, but it went into Amazon.com, e-commerce, in lowering prices to consumers. So it was actually lowering price inflation, not increasing price inflation, and it was creating disruption. And I think maybe that's what a lot of the inflationary bears missed.
Yes, and with the Austrian School, with the Cantillon effects, it's basically unpredictable to know the exact results of where all the money and credit will go, who will get it first, who will spend it first, and things like that. So, I think the Austrians, the mistake, like I said, was predicting hyperinflation immediately. Just put all your money in gold and silver, you'll be safe. And that, I think ultimately that we have stagflation now, and it could get a lot worse. And while a lot of people are just screaming deflation at the top of their lungs, but in the real economy, I think there's stagflation now. I think it's going to get a lot worse. Although with technology and other things, some prices are falling. But it's been an interesting conversation today, Kevin. I don't want to take up too much of your time. And if our listeners want to follow more of your work, how do they do so?
They can Google me, or they can go to bearingasset.com, our website.
Great, and keep up the great work. And I really enjoy your insights. And we'll see if some of those shorts you have on start to pay off in the near future.
It would be nice for a change.